On September 29, 2025, a handshake happened that would earn one bank more money than most companies make in a year. Goldman Sachs, $110 million for about 18 months of work. The deal? Electronic Arts, the company behind Madden, FIFA, The Sims, Battlefield, $55 billion, going private in the largest gaming buyout ever. But here's what makes this fee interesting. Goldman Sachs hasn't advised EA on anything, not a single dollar, for the past 2 years. So who were they advising? Saudi Arabia's public investment fund, $24 million in fees. Silver Lake, the private equity giant, $154 million. Follow the money, and you find Goldman collected $178 million from the buyers before this deal even started. This is how mega deals actually work. It started with a phone call in March 2025 when Silver Lake reached out to EA CEO. And then someone else got involved, someone with very specific connections. Jared Kushner, former senior advisor to President Trump, son-in-law of the current president, and founder of Affinity Partners, a private equity firm that manages $3 billion, 99% of it from foreign governments. According to Bloomberg, Kushner brokered the initial connection between EA and Saudi Arabia's public investment fund. He became, quote, a central figure in the talks for months. Affinity Partners, since 2021, has collected $157 million in management fees, zero profits to those investors. Not a penny. Quote from Senator Ron Wyden, Affinity's investors may not be motivated by commercial considerations, but rather the opportunity to funnel foreign government money to members of President Trump's family. In this EA deal, Affinity holds just 5%, but its real value isn't equity, it's access, political insurance for regulatory approval. The deal has to pass through CFIUS, the Committee on Foreign Investment in the United States, which is made up of Trump administration officials. Having Trump's son-in-law in the consortium, that's not a coincidence. One source told the Financial Times Kushner's involvement would ease the deal's path through CFIUS. Meanwhile, back at Electronic Arts, a different story was unfolding. In total, nearly 1,900 employees laid off, gone. BioWare, the legendary studio behind Mass Effect and Dragon Age, cut in half. Star Wars games, canceled. Black Panther, canceled. Titanfall, canceled. CEO Andrew Wilson called it restructuring for strategic priorities. The timing is interesting. Because here's what they don't tell you in the press releases. When a company is being prepared for sale, you cut costs, you lay off workers, you cancel risky projects, you make the balance sheet look clean. You create what's called in the industry a compelling narrative for buyers. EA CEO Andrew Wilson, he's staying on after the buyout, and he's becoming a major shareholder himself. The workers who got laid off, they don't get that option. They got severance packages costing EA between $40 and $55 million, while the buyers pay $55 billion. Now, Goldman's $110 million fee sounds massive, and it is. But it's not even the biggest fee this year. Bank of America is making $130 million advising Union Pacific on its purchase of Norfolk Southern. And JPMorgan, they committed $20 billion in debt financing for this EA deal, and they're expected to make up to $500 million just on the financing fees. This is the part that doesn't make headlines. The advisory fee is visible. It gets reported to the SEC. Everyone sees it. But the real money, the billions in financing, the ongoing fees, the currency hedging, the debt syndication, that happens in the shadows. But let's talk about what this deal actually is. $36 billion in equity from the Saudis, Silver Lake, and Kushner. $20 billion in debt from JPMorgan. That's $56 billion total to buy a company valued at $55 billion. EA currently has just $2.2 billion in debt. After this deal, they'll have $20 billion, nearly 10 times more. This is what a leveraged buyout looks like. The private equity firms don't use their own money to buy the company. They use the company's own ability to borrow, its assets, its future cash flow, as collateral. They buy it, load it with debt, and then squeeze profits to pay down that debt and pay themselves. The Saudis aren't doing this for nostalgia. This is part of Vision 2030, Saudi Arabia's plan to diversify its economy beyond oil. They've already invested in Nintendo, Activision Blizzard, Capcom. They're building an entire gaming ecosystem. But there's another layer here: cultural influence. EA Sports, Madden, Battlefield, The Sims, these aren't just games. They're platforms with hundreds of millions of users. They collect data, they shape culture, they influence how people see sports, war, even daily life. When a foreign government owns that, some people call it soft power. Others call it surveillance risk. The Committee on Foreign Investment, they're supposed to evaluate that. But here's the paradox. While lawmakers spent years screaming about TikTok, citing data privacy and foreign influence, calling it a national security threat, Saudi Arabia's public investment fund faces no pushback. They're taking EA private with majority control. TikTok was forced to sell with ByteDance holding less than 20%. What's the difference? Politics, relationships, money. TikTok was Chinese and didn't have Jared Kushner on the cap table. The EA deal has the former president's son-in-law brokering it. That's the regulatory moat. That's what Affinity Partners really sells. Not investment expertise, access. Now, not everyone thinks this is sinister. Silver Lake has a strong track record in tech. They've done deals with Dell, Airbnb, Alibaba. They're professionals. And the Saudis, they're not exactly new to American finance. PIF has stakes in Uber, Lucid Motors, Boeing. They've been investing in the US for years. Maybe this is just business. But consider what the employees know. EA lost $6 billion in market value in early 2025 after games underperformed. Dragon Age: The Veilguard, EA Sports FC, both disappointed. Layoffs followed, the stock struggled, and then, suddenly, a consortium appears, offering $210 per share, a 25% premium. Who benefits? Shareholders, executives who own stock, investment banks who collect fees, private equity partners, sovereign wealth funds looking for assets. Who doesn't benefit? The workers laid off before the deal, the studio shut down, the games that'll never get made, the gamers who'll eventually wonder, why does this company feel different? Because here's what happens after leveraged buyouts. The company gets delisted. No more quarterly earnings calls. No more public scrutiny. The new owners take it private and then they optimize. Sometimes that means innovation. Sometimes that means layoffs. Sometimes it means both. Elon Musk took Twitter private, renamed it X, laid off 80% of the staff. Dell went private in 2013, cut costs, then went public again in 2018 at a much higher valuation. Michael Dell made billions. The workers? Well, some came back, some didn't. The pattern varies, but the playbook is familiar. Silver Lake says they're honored to partner with Andrew Wilson and plan to invest heavily to grow the business. The Saudis talk about building ecosystems and fueling innovation. Kushner says EA is extraordinary and he's excited about what's ahead. These are the pitches, but pitches and outcomes aren't always the same thing. The deal is expected to close in early 2026, pending regulatory approval. That's where CFIUS comes in. And if you're wondering whether a committee of Trump appointees will block a deal that involves Trump's son-in-law, involves a foreign government that's paid that son-in-law $157 million in fees, well, history suggests probably not.